Hey everyone, welcome to the channel and the first ever episode of the Life of Stomzy show. I'll start this off with a question to you. What does the result of successful investing look like for you? Take a quick pause. Let me know what you think in the comment section. Is it the ability to buy a dream car? Is it the ability to buy a dream home? Or is it a bank account with multiple zeros at the end? Whatever it is, keep that concept in your mind forever because that is what's going to be able to drive you to make decisions that are best for you. On the Life of Stomzy show, our quest, our challenge, our goal is to see how we can be able to create generational wealth for ourselves and our future generations using the tools that we have in the world today. There's several tools, but mostly I'll be talking about stocks and ETFs. And I just want to share about my experience with the general audience, most of whom are in Africa just like me. I'll start off with a fact. As of January 1st, 2024, the United States stock market is worth around about $50 trillion. Yes, you heard right, $50 trillion. That is a lot of money if you try and convert that to any local currency. It's a whole lot, probably enough to break your calculator. And that's how much the United States stock market is worth. And these are all the companies, the basket of all the companies in the US doing business and being publicly traded or publicly listed. The stock market itself started around about the 1900s, early 1900s. So we're talking about 1910, 1920. And since then, up to date, it has generated a lot of wealth for a lot of people. The first thing to understand on how the stock market generates value for its investors is to understand that the United States is a powerhouse in terms of economics. There's something interesting that I noticed. If you try and Google how many African investors actually participate in this $50 trillion opportunity, there's not really much data out there. Unfortunately, there's a concept out there that's being peddled by multiple people, multiple companies, and this is the fact that you can be able to make money from your home by trading. And unfortunately, I'm a skeptic of that because the fact stands that 99% of traders out there will lose money. So it doesn't matter whether you're trading stocks, whether you're trading crypto, or you're buying and selling currencies. It doesn't really matter. At the end of the day, you will wipe out because the institution, the game itself is rigged against you. And that's a fact. And that's something that a lot of people don't want to accept as a truth. And they eventually go ahead and find out the hard way whilst losing a lot of money. Now, of course, there's some that have made money, but the number of these people is very minute, it's very small. Compared to the masses, probably even less than 0.01%. But does that mean that we are doomed? If we do not trade or if we don't do something, we're not going to be able to participate and actually have a slice of this huge pie that is being baked by the United States, for example. If you look at old sages, people who have done this over time, and I'm talking about John Bogle, the father of Vanguard. I'm talking about Warren Buffett, father of Berkshire Hathaway. These are people who've done it over time and they have preached a specific concept. Invest in something for the long term. And when I say long term, here I'm talking about at least minimum of 20 to 30 years. And that is how you're able to generate wealth for yourself, for your children, and for your children's children. I'll go ahead and show a couple examples on how this will look like over time. And I'll also go ahead and debunk a couple things around fees and expense ratios and the power of compounding on this video. So I'll try and make it brief as possible. So on this video, we want to go ahead and see the first steps to actually start cutting this slice of pie that the United States bakes. But before we even get to that whole starting of that process, we need to understand how the game is played. I want to start off by actually pivoting from this video into something that a lot of people, especially now here in Kenya, are looking at in terms of investing. And these are money market funds. Something that a lot of folks don't know is that there's always a fee that is charged to the amount of money that you put in, something that is known as asset under management fees. And these have different names. They could be called expense ratios, whatever it is, there's always a fee attached to it. And let's go ahead and check out some of these fees. So right now I'm on Google and I want to search this expense ratio for money market funds. Whatever comes, we're going to take a look at it and see how it's worded. So we'll go ahead and type expense ratio. All right, cool. So we have a first entry here, and this is Sanlam. Sanlam is for those who are watching from different countries, Sanlam is a company that offers money market funds and various other products here in the market. And I think they are based out of South Africa, if I'm not mistaken. Cool. So we have here the overview of the fund itself, the name, and why people should choose it. But I'm looking at this section right here, fees. So they charge an annual management fee of 1.2, but the expense ratio is 1.6. So I'm not quite sure if you actually need to add these two or the annual management fee is included in this expense ratio. But I'll go ahead and show you a different concept on how to be able to see how much wealth you're able to create and how much it's going to cost you over time. So let's go back. We've seen that was 1.6%. Let's look at Jubilee. This is also another company that offers money markets. And I'm not going to look through this. I'm just going to search for expense fee, expense ratio then. All right, cool. So we have here uh, the total expense ratio inclusive of VAT is at 2.7%. So I want you to make sure that you get these concepts right on what fees actually can do to your overall investment. So 2.7, Sanlam is at 1.6. So I think based out of this, possibly it's the annual fee plus the expense ratio in terms of actual fees. But if anyone from Sanlam or who has experience with Sanlam can go ahead and share this, that would be awesome. All right, cool. So let's just work with those two. So with Sanlam, I'm gonna hop into my mutual fund calculator from NerdWallet, and we're gonna look at cost of investment over time. So let's say we're going to start off with this number. We're going to start off with $1,000 and we're going to put in $1,000 every month. So per year, that's going to be 12,000. And let's work with 20 years. The rate of return, I'm not quite sure. So let's go ahead and check what Sanlam offers. All right. So let's work with this since inception, 13.2%. And this is, of course, not net of inflation, but we'll work with it. We'll work with 13.2%. 13.2%. And the expense ratio, as we saw, is there's an annual management fee of 1.2 and an expense ratio of 1.6. Let's add these two together. So that will be 2.8. And we'll hit calculate. So for 20 years, net with fees will be $801,356. But if you look at the ending value gross, it's 1.1. So you have paid $336,000 just for fees. It's a significant sum. But let's go ahead and increase this so you can see this concept over time. Cool. So gross value is 4 million, but the net value is 2.3. So along the way, cost of fees ate up 1.8 million. And you kind of like get the concept. So if we kind of like go back to what we had here for Jubilee, let's go ahead and see how their performance is like. Really quite see. Okay, here we go. Performance cumulative. Let's look at since inception, and it's at 21.2%. So great numbers, better than Sanlam if you're looking into investing into a money market fund here. So 21.2. And the expense ratio, as you saw earlier, was at 2.7. Let's start off with 20 years. Let's calculate. This is better. You have 3 million gross, but 2.2 net with fees, net of fees. And the cost of fees is around about almost $950,000. So quite a significant amount of money also um, being eaten up by the fees. But that's the price you pay to be able to retire comfortably, perhaps. Let's go ahead and hit 30. And this is a significant amount. I think anyone can be able to retire on this, and this is great. But look at the cost of fees, almost $10 million here. So it's pretty expensive. And to me, as someone who's looking to invest, I want to make sure that I'm able to reduce the costs. That's the first thing. I want to be able to make sure that I'm not giving up a lot of my wealth and losing it. In fact, at the end of the day, 21.2% is insane. But with the fees involved, I would like to keep that as low as possible. Let's just go ahead and see. If it was at 1.6, how much would I have? So you can still see the amount is 22.2 million, but I have 15 million. So down from 9 million in terms of the fees, now it's at 6 million. So I would want to, as much as possible, decrease this amount. I think the going rate for some ETFs out here in the market is at 0.25%. Perhaps, maybe this, I'm just giving a wide berth here, but it could be lower, it could be higher, depending on the fund itself. But if it's low, you can see now I have much more in terms of my overall net worth because the fees are low. So that's the concept that I want to discuss here in depth. Fees are actually things that affect your net worth over time. So if you want to leave this even for your kids and they say, you know what, let's double this. I want by the time my kids are in their 30s, um, I want them to be able to just sit back and relax. So we can see it's quite a lot of money just using what they have here in terms of the rate of return since inception. Of course, past performance does not indicate future performance, but we're just assuming that everything remains constant. This actually maintains itself at 21.2%. So they have a couple billion. So for sure, they're able to relax and take it easy for generations and generations. So that's how you're able to create wealth using a money market fund. But if you look at the stock market, which is something that is a little bit more attuned to you being able to manage this yourself, it's quite easy to actually achieve this as well. I'll give you an example. If you look at what Warren Buffett has done across the years, he's been able to outperform the stock market. And the stock market has been returning since inception, and this is in the 1900s, around about on average 10% annually. It's not a lot, but this is over time. Of course, there have been dips with the Great Depression, with the dot-com bubble, the real estate subprime mortgage crisis in 2008, and so on and so forth. So there are a couple dips along the way, but those are opportunities for people like you and I to be able to buy in whenever the market is discounted. So of course, usually a lot of fear being mongered and being sold to investors that makes them want to sell their stocks. And that's not the way to go. You want to hold this forever and ever if possible. So right now, what I'm showing you on my screen right now is one of the tools that I use. This is known as FinViz, and it gives an overall view of what the market is like. So this is pre-market today, and we're already seeing a little bit of activity, but we get a general understanding of what's going on this view. But say, for example, I want to go ahead and purchase a stock, or I'm interested in putting it into my watch list, a stock of something that I use. A lot of folks use iPhones nowadays, or any Apple device. It could be a Mac, it could be AirPods, it could be an Apple Watch. And that's one of the companies in the Magnificent Seven, in the what we call the Magnificent Seven, which are the top 7 companies in the S&P 500. So let's go ahead and take a look at that. So we'll go ahead and drop in the ticker symbol, which is how we identify a company on the stock market. And for Apple, that's AAPL. And we'll drop in here and go to check out Apple Inc. So this gives us a rough understanding of what's going on here on a daily view. The information here, of course, I won't dive into it. It's because it's an introductory video, but this is just how it looks like if you're trying to start to understand what the market is offering. And if this is a bit too much for you, there's an easier tool out there known as Qualtrim, and this is much more easier in terms of the visuals. So I already have Apple typed in here, so I'll just go ahead and hit search. And this is much more easy to understand, easy to digest. So we have the valuation section here, we have the dividends, we have cash flow, margins and growth, balance, and the price, and how it's looking as of today, which is the 26th of August. Uh, this is pre-market. So on Friday, the market surged, and Apple surged about 1.03%, and that resulted in a gain of $2.31 to the price. So if you have Apple in your portfolio, looking to have Apple in your portfolio, these are some of the things that you take a look at. So I'm looking here at various fundamentals here, and this is the price. We have revenue by segment. We have EBITDA, free cash flow, net income. All these things are things that we use as fundamental information to be able to help us make a decision on purchasing a stock. So right now what I'm sharing is a backtest portfolio visualizer. So assuming that you started purchasing stock of Apple a while ago, how is that looking like for you today? So I'll just go ahead and check this out by opening the portfolio visualizer here. So I'll go to models, and I will actually go to tools, my bad, and I'll say backtest portfolio. And then this just gives you a sample of what to expect. These are various ETFs. This is going to be covered in a different video altogether. But let's go ahead and hit edit portfolio, and I'm going to get rid of this. And I'm just going to put in here Apple. And let's say I own 100% of Apple. This is the only stock in my portfolio. So I'll just get rid of these numbers here and put that at 100. That's happy. And I want to go ahead and click on settings so that I can say I want to fine tune this so that it looks a little better here. So let's say I started investing in Apple 24 years ago in 2000 and the end year is 0. So include white year to date. I'm going to say no. And I invested, let's say I put $5,000 in Apple. And I'm going to leave its cash flows as none because this is what we know is known as dollar cost averaging, which is basically putting in money over time. So I'm just going to say I put $5,000. I didn't add anything in this 24-year period. I did not use any leverage. I didn't borrow any money to be able to make more money. But I did reinvest the dividends. So I didn't touch this money. I just let it sit and work for me. So all this looks good. I'm going to leave it as that. And I'm going to click on Analyze Portfolio. So with Apple, this is the annualized return, 25.8%, and the benchmark itself, which is the S&P 500, which is the basket of 500 most valuable companies in the United States, was at 13%. So I've outperformed them over this 24-year period. The standard deviation is 28.21%, but the drawdown is a bit high. So I have suffered around 30% reduction in capital gains over time. So this is a bit high, but that's why folks are encouraged to diversify their portfolios. So we can look at the performance summary here. Start balance is at 5,000, ending balance is at 45,000. So I've seen a CAGR in terms of returns of 25.8%. Super huge. My best year would have been 88.9% in terms of gains, and my worst year would have been negative 26.4%. And the maximum drawdown, of course, is that 30.45 or 0.46%. And a Sharpe ratio. So this is irrelevant for this one here. But we can see this is how it's grown over time. And this is how you can be able to generate wealth for yourself and for your family over time. And say, for example, after 2024, maybe from next year, I just want to be able to enjoy the dividends. I know this $45,000 from this stock will be able to return quarterly dividends for me from Apple every single year because they always pay out a dividend. So this goes ahead and breaks down how it looks like over the time. 2015, 2019 was the best year, of course, with 88.9%. And this is how you can be able to just start understanding how you can start put money away for the long term and enjoy capital gains when you're retiring, for example. So that's the concept in a nutshell. And hopefully this has been able to show you how you can be able to generate generational wealth for yourself and for your family over time using the stock market in the United States as your tool. You don't even have to do much. It's super easy, and we're going to cover more in this channel on how to get started. For now, thanks for taking the time and if you like this content, feel free to subscribe, like, and share this video with your friends and family. You can also go ahead and check out my Patreon page. I cover more detailed information in there, but just go ahead and check it out.